a stocks list that we'll get to in just a bit. Robert Sorkin is global economist at Citi. He's joining us. Robert, great to have you with us here. Thank you very much. Would you describe what we've heard from the Fed and the Powell Q&A, etc., as being extraordinarily dovish, Robert? What's your sense?
Yeah, absolutely. And thank you so much for having me. I would say if you were thinking about what could be the most dovish response that the Fed could have at this meeting, given the data that we've had and given their previous communication, I think this came pretty close to being at that dovish extreme that you could possibly expect. Pretty much at every point throughout Chair Powell's press conference, he leaned in an increasingly dovish direction, in particular emphasizing that at this stage, they did discuss rate cuts at this meeting, which just a few weeks ago, he emphasized that rate cuts were not being discussed actively. So really kind of leaning into that market expectation that rate cuts are going to come sooner rather than later. And if you look at the forecast, you see really growth forecasts that have not moved too much, unemployment rate forecasts that have not moved too much in coming years, but a significant markdown in inflation and a pull forward of more cuts into next year. And really, it's hard to find anything in Powell's press conference that you can point to as hawkish. So even though there's still technically the option of hiking further, and that's something Powell said, really, that's not something that the markets believe, and that's not something that the data would argue is likely. Really, I think this is about as dovish as Powell could have been today.
This is, I think, come as music to the ears of investors across the world, right, in the equity markets. So, Robert, I wanted your thoughts on how you would approach the Indian markets now, because all eyes on when the RBI will start to ease its own monetary policy. Do you think the equity markets are going to start factoring that in now?
That's a great question. And I think one thing that's underappreciated in terms of the global monetary policy landscape is that, yes, some emerging markets have been able to start easing policy. Other emerging markets, like India, were set to follow soon after. But all of these central banks are likely glued in some respect to what the Fed and other DM central banks do, that there's only so much that EM central banks can diverge from these DM central banks without risking a big move in their currency. So I think the fact that the Fed pretty much delivered on as dovish as it could be and really started to pull forward expectations of potential rate cuts, I think that's a big positive for other economies as well. It probably means that EM central banks will be able to move forward with their easing cycles and potentially even start easing policy more rapidly than expected. So I would expect this would be a big positive for emerging markets.
Hi, Robert. Good morning from India, and good to see you in. Robert, the last time we chatted, I think you were drifting towards maybe not a too dovish sounding Fed, but he's delivered, right? He's very, very dovish. Now, the problem is that the dot plot is suggesting that maybe we get 75 basis points in terms of a rate cut, while the markets are factoring in double of that, 140, 150 basis points. What do you think we get in 2024?
This is a great question, and I would break it down along two factors. One, a debate around how many rate cuts we get. And actually, going into this meeting, we have 100 basis points of rate cuts next year. So actually a little bit more than the Fed was guiding, but a little bit less, as you said, than what markets are expecting. So we very much are somewhere in between those two. But the second factor, which is just as important, is when the Fed will start easing. And right now, we're still not expecting rate cuts until July of next year. We think that the Fed is going to want to see more definitive evidence that inflation is moving decisively to target. Wage growth is still elevated. Certain services prices are inflation is still elevated. So we think that's going to keep the Fed from moving too quickly. But certainly after this meeting and after some of the encouraging inflation data that we got this morning, the risk is that the Fed starts cutting sooner. So we do expect rate cuts next year. We expect a bit more than the Fed is guiding, but I think there's enormous uncertainty around when that starts. And it's entirely possible, given Powell's communication today, if the data continue to cooperate, that the Fed starts easing early next year.
Robert, just one last question. The fact that the Fed is suddenly saying that rate cuts are coming into view and talking about 75 basis point rate cuts, even though their own estimates of growth are not very weak or anything, does it show you that they are perhaps seeing weakness creeping in a very fast way sometime next year? Growth weakness.
I think Powell's been very careful not to say that the Fed's base case is a soft landing. Obviously, that is the goal, but he's been very careful to fully lean into that direction. But I think if you look at their forecasts, yes, they're expecting a pickup in the unemployment rate, but a relatively mild one. And they're expecting a slowdown in growth, but a relatively mild one, while inflation moves back to target. So I would describe the Fed's SEP forecast as pretty close to what I would think would be a soft landing, even though the Fed doesn't want to lean directly, into that. Now, our own view is that that path to a soft landing is still challenging. We still think there's going to be a larger slowdown next year. We're starting to see some evidence of that on the activity side.
Right.
Even though growth has been resilient, there's some stresses in lower income consumers. Credit conditions have tightened significantly. That's still playing through. But if you look at what the Fed's thinking, I think they're getting more and more hopeful that they're going to achieve that soft landing.
All right, Robert, we leave it at that. This is a big, big trigger for our markets as well. So we're all set for a big morning of trade. Thanks a lot for joining in and being a part of that, for us. Let's slip into a quick break on that note.
As we take that break, take a look at that flash at the bottom of the screen. The 10-year is, in the morning, we were just
Below
saying
4%.
that we will be 3 point something. I think we've fallen to about 3.97, 3.98%.
Yes.
And it's quite incredible. I was actually thinking in terms of why this is such a big day. If you remember the election outcome, I mean, just comparing it to that one. Going into the state election outcome, I don't think anybody really had a doubt about what will happen in the general elections. But there was some anxiety building, right? And the state elections came in, and it was clear, and things suddenly said, well, there's certainty now.
Yeah.
In a similar way, markets were expecting rate cuts in 2024, but now you've basically heard it from the Fed chair and others, all of them basically saying
in
that
unequivocal terms.
we've kind of had them now tell us that, well, that's what they're perhaps thinking of doing.
Absolutely, absolutely. It's a big, big day for the market. So let's do one thing. Let's take a quick break. There are, of course, a lot of stocks that you need to track as well. Lots in the banking space, in the real estate space. All of that coming up in just a bit with our top 10 list of stocks. Stay tuned.